Hello, I'm David Maurice, Certified Financial Planner here for Worthwhile Wealth Counsel, doing a little bit of a bulletin for you long-term investors. We're looking at our weekly index and funds report, which many of you know we look at, of course, every week. And this time we wanted to step back a little bit. Instead of looking at just the weekly pattern of performance across these 20 plus indexes and the funds, we wanted to look at the trailing period. Now here, after this really sneak bear market has come up and smacked us all, for long-term investors, there's a big difference in how this looks after the sudden, almost like an explosion with this bear showing up, really coming out of nowhere. And of course, that's because of the pandemic, not really economic or market conditions as such. And so while we typically look at that 1 week, we want to look at what has happened and how dramatic the difference is at the different places in the market where this bomb has gone off. It's almost like looking at the crater after an explosion like this, and the contours of that crater look different in different places because it's impacted in such different ways. So if we look at just your typical benchmarks everybody sees at night, the S&P 500, the Dow Jones, and what we're going to look at here as those large companies that are reflected in those two indexes, we're going to look just at the growth side. First, looking at just big companies in the United States, those stock prices for the growth companies. And we see that even though we're still down around 4.5%, we have recovered a lot of space since the sudden downturn back in late March, mid to late March. We see now that if you look at the 1 year trailing period, it is still just under 9%. So how could we have gone down over 20%, still be down around 4.5%, and be looking at almost a 9% return over the 1 year? Well, that's because we had such dramatic growth during the period between the end of 2019, or really all of 2019, after its sort of a shaky start there in the first quarter. It was so good, almost 36%, in fact, just a little above 36%, that it has impacted those trailing periods. If you go to the 2 or 3 or 5 or 10, 15-year periods, then it's almost looking like almost nothing happened. For example, in the 3-year trailing period, the S&P is up significantly, still just under 8%, but the large growth side is just under 15%. So 3 years trailing from now, that last Friday report, is 14%. If you go to the 5-year, it is 11.5%. The 10-year is 13.75%, and the 15-year is still well above 10.5%. Now, here's where it gets interesting. When we go from large growth to large value, we see a very different picture, because large value is still behind by 12.8%. So you have an 8%, almost 9% 1 year trailing period for growth, but still looking at the large companies, the value side is still 12.8% negative. That's the 1 year period. If you go down to the mid-sized companies on the growth side are still negative 8.7%. But if you go to the value side, and my partner Lois, both in marriage and in business, likes to think of these benchmarks, these indexes, as being families. We have large companies, we have mid-sized companies and small companies, and each one of those has 2 children. One is the growth child and the other is the value child. Growth tends to beat up most of the time on value, but every once in a while, value just sticking with it, kind of like that tortoise and hare picture. Value just every once in a while trounces on the hare, the growth side. So that's what we're seeing here. We get to the mid-sized companies, we see a huge difference. Mid-cap growth is still down 8.7%, but mid-cap value is down 25% still. And if you go to the small companies, now you're getting into even more deep crater. The small growth companies are down 14% for the 1 year trailing, but the small value companies are down 32%. 32% still. That's a deep hole. Whereas at the large growth, we remember we're up this from the bottom of the crater to just almost the edge of the crater, 4.3% negative for the year to date, but 8.95 for the 1 year trailing. Now, the good news in all this is, well, you just think that's terrible for the value companies. But you know, when a more typical bear market comes along, one that's different than coming out of a pandemic, something that is more driven by economic fundamentals, or maybe the prices of stocks getting overpriced, the kind of thing that typically ushers in a bear market. When we see something more like that coming along, we usually see growth companies getting hit the worst, staying down the furthest, and the last ones to come up, whereas value companies, oftentimes, both at really at all three, large companies, mid-sized companies, and growth companies. When we saw the tech bubble that blew up in 2000, this is exactly what happened. In fact, we saw small value companies didn't go negative until the third year, which means if you own those things that tend to do well during more average type bear markets, then those are going to be the ones that hold up your portfolio. This is the reason that a well-diversified, globally diversified asset class portfolio spread across many different buckets, many different asset classes and categories, things like we've been talking about here, the large companies, the mid-sized companies, the small companies, but both growth and value in each of those, and doing the same kind of thing that you can find these different sub classes and categories in fixed income and in foreign stocks and in foreign bonds, fixed income, and things like REITs and commodities. These things we never know in a bear market that might endure longer than we expect this one to. Those things that diversify your portfolio the most, we don't know which ones are going to do well in the next bear market, but some will do better than others. Some will fare far worse. We will see things that are why we even look at having these different asset classes in a well-diversified, strategically designed portfolio, globally spread across the world. This is David Maurice. I'm Certified Financial Planner for Worthwhile Wealth Counsel. Thank you for joining me.